Well, good morning. Thank you, Christian. First of all, let me say congratulations to Christian and Rosa for this third edition of Value Spain, which I think has become just about my favorite value conference of the year, combining a great location, great speakers, great time of year, at least for we Northern Europeans, as well as a reasonable price. So it's a great pleasure to be the lead-off speaker this morning. Indeed, it may be a little more than that, given that, as you'll have heard, yesterday Prime Minister Theresa May finally triggered Article 50 to kickstart the formal leaving process from the European Union. This may be the last time ever in Europe that a Brit was first in the queue. I'd like to talk to you this morning about a stock called JD Wetherspoon, which operates pubs in the UK. It's a billion market cap, a little more, 1.6 billion enterprise value. Specifically, I'd like to talk to you about 6 reasons why this stock is unloved, unappreciated, and undervalued. So the first of those reasons is that it operates in a pretty lousy industry. Let me try to explain. Historically, most of the pubs in the UK were owned by a handful of brewers, national and regional brewers. You may remember some of the names: Bass, Whitbread, Grand Metropolitan, Guinness, as well as some smaller regional brewers. But this had always been a concern for consumer groups, competition authorities, over the ability of the large brewers then to restrict the range of beers that would be sold in pubs. And so in 1992, the competition authorities imposed a 2,000 limit, which effectively forced the large brewers to sell off the majority of their pubs. Now, pubs are intrinsically quite attractive assets, high and stable cash flows, property backing. In some cases, they have some of the characteristics of franchise businesses, those pubs that are run by tenants rather than managers. Means that it's can be a relatively asset-light type of business. Anyway, these characteristics attracted the private equity firms when the brewers were forced to sell off their pubs. And so by 2004, you had 4 companies: Enterprise, Punch, Mitchell & Butler, and Spirit, controlled a majority of the pubs. Their private equity owners loaded them up with debt and took them public in the late 1990s. This coincided with a bit of a tough time for the industry, leading eventually to pretty much all of these companies doing very substantial, deeply discounted secondary issues during the financial crisis, and at least in one case, a financial restructuring for Punch, and the others came pretty damn close too. One of the problems that they faced is that beer consumption has been falling. Whoops, how do I go back? Sorry about, okay, got it. So one of the problems was that beer consumption has been falling in the UK for a very long time. So on the left-hand side, you've got annual beer sales. The red line is total, the solid blue line is in pubs and restaurants, and the dotted red line is the so-called off-trade consumption of beer at home. And thanks largely to kind of cheap alcohol from the supermarkets, consumption at home has been rising up till the financial crisis, and pretty steady after that, which means that so-called the on-trade in pubs and restaurants has been declining by, over the last 5 years, by 2.7%. And as a result of that, pub numbers have been declining by 2% for as long as anybody can remember. But here's my first but. In this environment, and despite these headwinds, JD Wetherspoon has been growing pretty steadily from its IPO in 1992. The number of pubs has reached about 900, and revenues is now up to about 1.6 billion. In particular, revenue growth over the last 5 years has been 8.3%. So this is something that I would like you to remember all the way through my presentation. Wetherspoon has been thriving in an era where the industry has had quite a lot of trouble, and most of the competitors have done relatively poorly. The second problem is that the macro environment has been tough, affecting both demand and margins. We've had cheap alcohol from supermarkets. In the UK, we had a smoking ban in 2007. Of course, there is quite a correlation between heavy smoking and heavy drinking, at least there used to be. And as a result, this could put a lot of pressure on volumes for most of the pub operators. So much so, in fact, that most of Wetherspoon's competition have almost changed focus, and they're less pub companies these days and more casual dining chains. However, their legacy pubs were not really well suited to this change, being much smaller, much older, less space for kitchens and dining areas, relatively undercapitalized. We've had weak average wage growth pretty much around the Western world for a very long time. That too has not been good for alcohol consumption, particularly in pubs and restaurants. And of course, we had the financial crisis and the recession from 2008, followed by a pretty weak recovery. At the same time, cost pressures have been rising, not only commodities, but rates, business rates. From 2016, the UK government introduced a higher minimum living wage. And to be quite honest, government tax policy is really quite hostile towards the pub industry, so much so that, in fact, Wetherspoon paid 42% of its sales in tax in 2016. That's not just corporation tax, of course. That includes VAT on food, it includes alcohol duty, it includes all kinds of payroll taxes, it includes business rates. So there's a wide range of different taxes that it pays, but even so, 42% is a pretty astonishing number. Here's my second but. But Wetherspoon is doing something very different from the rest of the industry. As I said before, most of the competition really are morphing into casual dining chains. Wetherspoon has a low-cost, low-priced, high-volume strategy to maximize throughput in the pubs and cash flow through individual pubs. And the best way of kind of visualizing this difference in strategy is to take a look at what the Wetherspoon pubs look like. These two pictures are of a pub called The Capitol, which is just south of London, which in 1929 opened as a cinema, a film theatre. It was closed as a film theatre in the 1970s, and it became a bingo hall. Wetherspoon took it over in the 1990s and converted it into a pub. As a result, it is absolutely huge, and this is typical of Wetherspoon's pubs. They are like 3 to 4 times the size of the average competitor's pub. That gives them the space to put in kitchens and dining areas. It gives them the flexibility to design the pub for the specific purpose and to suit the particular area. Very often, Wetherspoon pubs have car parks and gardens. As I said, they're newer, they're purpose designed. They are all in high footfall locations. So you don't get in your car on a nice summer's evening and drive out to a Wetherspoon pub to have a pleasant evening and dinner with your wife. Wetherspoon pubs are places where people go to drink cheaply and to eat cheaply in the high street and in other high footfall locations. Something else which is true of Wetherspoon pubs, 100% of the pubs are managed. That is, the pub manager is a Wetherspoon employee and Wetherspoon owns the business. Most of the competitors have tenanted pubs where the tenant owns the business and the pub company is more of a real estate play, and the tenant basically pays rent to the pub company either directly or indirectly by being required to buy their beer through the pub company. This, of course, is one of the reasons that the private equity companies like them. It means that it's relatively high margin revenue, lower revenues per pub, but higher margin. On the other hand, some of these tenants turn out to be not very good managers of pubs, and the pub companies have much less control over the business. The third problem that's affecting Wetherspoon's attractiveness in the market is that margins are declining in this tough environment. It's true of all the pub companies. It's true of Wetherspoon's, and actually this is kind of pretty dramatic. You can see that they've almost halved from just north of 12% to about 6.5%. Not just north of 12% in 2000 to about 6.5% in 2016. But Wetherspoon would argue that this is irrelevant, almost irrelevant, because each pub is a relatively fixed asset base. It's a relatively fixed cost base. And so if I can put through more and more incremental revenue, even if it's lower margin, that's still maximizing my free cash flow per pub. I'm still doing good things for my shareholders. And so when you take a look at return on equity and return on capital, you don't see this same decline that you see in the margins. You see something that's relatively stable and relatively high. There is a little bit of variation here because I'm using a free cash flow return on equity calculation, free cash flow return on capital, and the working capital is a little bit volatile. But broadly speaking, you can see that return on capital is stable at around 14%, something like that, and return on equity is stable. At least there's no noticeable downward trend at around 20%. Of course, much, much higher than cost of capital. The fourth reason why I think the shares don't attract much attention is that at 950 pence, which is about the current price, the shares don't appear necessarily particularly cheap. About 4.5 times book, 19 times historic if you exclude the exceptionals, and 17 times forecast. However, I think this too is misleading. This is my fourth but. If you look at it on a free cash flow basis, free cash flow being after maintenance capex, I think the shares yield about 9%. And free cash flow per share has been growing by something like 5% over the last 5 years. The reason for that is that the company is incredibly conservative, both in terms of operating and financial reporting. And so, in particular, the depreciation is particularly aggressive. That is, depreciation is much higher than its competitors. Probably about, as far as I can figure out, they're depreciating about twice as fast as the competition. Negative working capital gives them good free cash flow. They may not be the largest owner of pubs in the UK. It's at about 900. Enterprise and Punch, I think, both own about 4,000 or 5,000. But because they are tenanted pubs rather than managed pubs, they don't control the purchasing of beer from the brewers in the way that Wetherspoon does, and so Wetherspoon actually has a higher proportionate negative working capital component. In terms of the accounting, Wetherspoon expenses a whole range of things that other competitors capitalize, and they do give you a breakdown between maintenance and growth capital, and this I think is particularly interesting, that the only thing that counts as growth capital is the opening of new pubs. So a few of the pubs have hotel rooms in them. If Wetherspoon increases the number of hotel rooms in an individual pub, maintenance capex. If they increase the size of the kitchen or the dining area or the car park or the beer garden in an existing pub, maintenance capex. So very conservative, both operating and financial management, contributes to the fact that the shares look expensive when you look at conventional P&L measures, but actually, as I said, the way I do my sums, it looks like about a 9% free cash flow yield. In addition, I think this is not well appreciated, Wetherspoon has a lot of pricing power. A lot. That's an exaggeration. They have some pricing power. In the top left here, what you see is the average market price of a pint in a UK pub, which basically has been growing by 4% with or without tax, however you calculate it, for the last 15 years, indicating that the market, there's some pricing power in the market. In the bottom right-hand side, what you see is a calculation of the average discount, how much cheaper you can buy a pint in Wetherspoons compared to the competition. And it generally varies between about 15 and 20%. So there is some scope there for Wetherspoon to raise prices, and indeed they have been raising prices fairly consistently to offset some of these cost pressures. Finally, Wetherspoon has great management. Some people may be familiar with the founder and the executive chairman of Wetherspoon, a guy by the name of Tim Martin, who gained some notoriety because he was very vocal in the EU referendum on the Leave side. He opened his first pub in 1979, having qualified as a barrister and deciding not to go into law. He named the company Wetherspoon after one of his school teachers who famously told him that he would never amount to anything in life. And his original idea basically was to buy beer close to its sell-by date from brewers and sell it at a big discount in a kind of clearance sale so that he could get very high throughput, very high volumes in his pubs. A policy which is still in force today. By the way, you shouldn't get the impression that just because beer in a Wetherspoon pub is cheap, it's not very high quality. Wetherspoon has the biggest range of beers that you will find anywhere in a UK pub, from the very cheapest lager to the most expensive craft beer, real ale as we might call it in the UK. I mentioned that in terms of management, 100% of the pubs are managed, none are tenanted. They own 54% outright, 46% are leased. They never revalue the pubs. Basically, all of their competitors revalue the pubs every year. They're required to because they have much higher debt levels and they have loan-to-value covenants. With much lower levels of debt, Wetherspoon doesn't have to do that. It doesn't have LTV covenants on its debt. As they told me, it would cost us £300,000 a year to do the valuation, so we'd rather not spend the money. This is one of my favourite considerations. They are outstanding capital allocators. Basically, they have a capital allocation meeting every Friday morning. Of course, pubs are, as I mentioned, are highly cash generative. Cash is coming rolling in all the time. And essentially, the marginal decision that they're making every Friday morning is, do we open more pubs or do we buy back shares? And their threshold is 12%. That's their calculation of a cash return on cash invested. Because they think that if they open a new pub tomorrow, they will get 12% cash on cash return. So if they think the shares are yielding more than 12%, they'll buy back shares. Otherwise, they'll put the money into opening more pubs. As a result, they have bought back half the shares since 2013. And of course, executing this policy means that they have bought shares when they are particularly cheap, and they've not bought shares back when they're more expensive. Tim Martin has not sold a single share, so he owned 15% at IPO. Given that they've bought back half the shares, he now owns 30% of the stock. He's also, there's something else that I really like about him, is that he seizes every opportunity, every single trading statement, every single set of results, occasionally when he's been in the public domain concerned with Brexit. He takes every single opportunity to criticize government policy towards the pub industry, to criticize the role that private equity firms have played in the industry, putting the competitors' pubs under so much pressure, corporate governance. If you read a Wetherspoon annual report, all of the guff is at the back. So you get the chairman's statement, the accounts and the notes, and then at the back you get the corporate governance report, the remuneration report, the director's report, the auditor's report. All the rubbish is right at the back. He also takes every single opportunity to bemoan the pressures that the industry is under, rising costs, higher taxes, and so on and so forth. And the thing is that the stock market interprets these nearly every single time as a profit warning, marking down the shares. But when you read very carefully what he's saying, and you listen very carefully to what he's saying, he's usually describing the industry, not Wetherspoons. Remember what I said at the beginning, this is a stock that has done well at a time when the industry and the competition has done relatively badly. Anyway, although of course it's not admitted publicly, I have this sneaking suspicion that it's entirely deliberate to push the share price down so that it can buy back more shares more cheaply. So I shall just finish, if I can change the, oh, here we go. Sorry about this. Hopefully that's it. So in summary, and basically my final slide, I think of Wetherspoons as a 20% return on equity, admittedly free cash flow, normalized my adjustments, a 20% return on equity compounder, which you can buy at basically 11 times normalized free cash flow. It's a great company.